Thank you all, and thank you for joining. And we're really sorry for the technical difficulty. The previous link didn't work. And welcome to the webinar arranged by Bangladesh Medical Association of North America. I'm Dr. Bashir Ahmed, the acting president of the organization. And we're very lucky and happy to have Syed Nishat from Wall Street Alliance as our speaker. And we will be doing this meeting as a webinar where the speaker will be talking about different relevant items on the current market situation as well as our financial policy. And you will be joining here as an audience, and you can raise your hand or you can type in your questions. And all the questions will be going through me as the moderator of the session. It is not live interactive session like other Zoom meetings. So please feel free to raise your hand and or type in your questions in the chat box that you will find at the bottom of the scroll bar in the middle, and click on the chat box and then type in your questions. So again, we have Mr. Syed Nishat as our speaker. Let me give you some introduction about him. First of all, he's from Bangladesh, and he's also from my same school. I didn't know that until a few minutes ago. So he graduated from the same school that I did, Dhaka Collegiate School, just 10 years after me. He's very experienced, and he has been involved with the community, especially Bangladesh, Indian, and Pakistani Medical Association, and he has been in his practice of financial advising for many, many years. We are lucky to have him. So I will be going right into our session. That having said that, we are seeing a lot of volatility recently in the market. S&P is down 20% from the top, and some are already calling that we are heading into recession and we are in a bear market. And as physicians, we all work hard and we are concerned about our portfolio and how the market will move from here. So we'll be starting with an opening question to Syed Nishat. Syed, what should be our investment strategy in the market decline?
Yeah, thank you, first of all, Dr. Ahmed, for the kind introduction. And it's a coincidence to meet someone from the same school that I graduated in 1995, and same teacher we spoke about it. It's amazing. And when I came to this country from Bangladesh, my father, when I told him that I want to be a financial advisor, he sounded very disappointed, because back home, investing means either buy land in Bosundara or buy gold. So that's pretty much the norm back home. But I told my father, I'm saying the same thing here into the audience, that like it or not, in US, financial planning is the foundation to give your family stability. Now, obviously, we're seeing a lot of volatility in the market. But before talking about the market, I just want to give you some generic tax planning advice to the physician audience so they can understand how it may impact them. Now, Biden administration recently, as you know, almost issue a $3 trillion infrastructure bill last year, if you see the bills in Senate. And overall consensus, the tax must go high regardless of what you do. So there's a lot of bills in the Senate right now, but let me just show you a screen real quick. If you take a look, people will be affected the most if your income is more than $400,000. So for example, if your income is $400,000, your tax grow up from 37% to about 40%. You might be thinking, what's the big deal, 3% jump? But the problem is that any income more than $400,000, the government is talking about paying additional 12.4% Social Security tax, which is a lot. Currently, if you are a W-2 employee or if you have your own practice, you do not pay any Social Security for any income more than $136,000. So Biden is saying that any income more than $400,000 additional taxes are there. And also, a lot of physicians are self-employed. You take something called itemized deduction. The deduction tends to go away if your income is more than $400,000. Again, it's very important to speak to your CPA and financial advisor and see somehow if you can lower your income or not. Now, there are some strategies I want to discuss about for tax planning point of view. This year, 2022, is the only year if you have business expenses for food. Usually, if you spend money on food, you only get 50% deduction. But this year, you can write off 100% deduction for food expenses. Dr. Ahmed, you're in Florida. There's no state taxes, but in New York, New Jersey, we have a huge amount of tax. Like New Jersey, we have 7% tax. New York, we have 6% tax. But there's something called SALT, S-A-L-T, was passed when Trump became president, that the state tax and property tax, the maximum deduction is $10,000. I don't know if you recall that, but if you have your own corporation, if you pay the same state tax from the corporation, you can get to write off that as well. Certain states, not Florida, the states that actually has state tax deductions from New Jersey, New York. So it's very important that if you have your own corporation, elect to pay the taxes from the corporation. Just in case, if you need a bigger vehicle, this is a good year to have it, because if the vehicle weighs more than 6,000 pounds, you can get to write out the full purchase price of the vehicle as well. And then a lot of, like my father, I used to invest property in Bangladesh. A lot of physicians invest property in New York or New Jersey and throughout the states as well. So if you invest into property, there's something called depreciation. You speak to your CPA about cost segregation. It's a method, it's a study. What cost segregation does is lower the depreciation for the property from 39 years to 5 years. So you can get a bigger depreciation, you can get to write off all the rental income. And lastly, last year, Secure Act was passed. Because of Secure Act, you can set up a pension plan if you have your own practice for last year, this year, even if you want to, if you are filing for extension. So defined benefit plan is a pension plan, is very important for self-employed physician. In a defined benefit plan, 52 years old can contribute almost $193,000, and this money is completely tax deductible. So if you're in a 40% tax bracket, we're looking at a tax savings of $77,000 a year. And in 10 years, that translates into almost $700,000 profit. So that's $7,000 tax savings. So again, everyone's situation is unique. So speak to your CPA if a defined benefit makes sense for last year and also for 2022 as well. So these are in a nutshell. I just want to talk about that from a tax planning point of view. The physician can sit down and speak to your CPA and financial advisor about this.
Thank you, Syed. Before we move into the next topic, I just wanted to let my audience know that Syed is a partner of the Wall Street Alliance Group, and he regularly appears in interviews and also publish articles in different financial news outlets, including MedPage, Medscape, and he's also been regularly interviewed and quoted media like Forbes, Kevin MD, US News, etc. As I said, and also Syed mentioned that this webinar is for education purpose only. So before you make any financial decision, you must discuss this with your CPA or your financial advisor. So having said that, we will be moving into the next discussion topic. But Syed, as a physician, I know that the first three topics that you said, these are the key things. Actually, like because of the timing issues and we started late, you had to go fast. But I want to assure my audience that these will be available for all of us to go over. And then if you feel that you need to ask any supplemental questions, Syed will be available during our convention. And we also invited him to come and join with us.
Dexterity modeling has improved.
Yeah. Yeah. So yeah, can we mute?
Also,
yeah. Ajay, can you mute your phone, please? Thank you. So the next topic that we will be discussing, what is the main reason for the market volatility at this point, and what do you think the outlook will be?
Yeah, it's a great question. I mean, for the last, few weeks, we are seeing a lot of volatility in the market. I was talking to a client of mine, Dr. Ahmed, a few weeks ago. I was calling him to congratulate him because his son graduated the residency program. And I was calling to congratulate the son, but the client sounded very nervous, and he think the market will collapse almost 50%. And the client was suggesting the best thing would be to sell everything and sit in cash. So I'm doing it for almost 18 years. This kind of knee-jerk reaction is very common when the market goes up and down. But investors must understand, Dr. Ahmed, that since 1928 till now, I'm talking about last year, S&P went down 28 times, more than 50%. Again, let me repeat, since 1928 till now, S&P, which is the index for the Standard & Poor, went down 20 times, 28 times, more than 20%. And each time market fall for different reason. But one thing is very common, that each time market fell, the subsequent year, market not only break even, but also it went up double digits as well. So the investors who are very panicked, they're trying to like sell everything and sit in cash. They're better approach in it, because in the long term, market always goes higher. Now, to answer your question, Dr. Ahmed, that what is the reason for the market volatility? The main reason is the trillion-dollar question is whether we're going to have a recession. Now, before we talk about recession, let's just talk about how we got into it. I don't know, in your area where you live in Jacksonville, but my client recently purchased a property in Orlando, Dr. Ahmed, in 1 year ago. The price went up 20% in 1 year. In suburbs, in New York, if I want to buy a house, there's a 5 bidder out there. These are sign of something called inflation. Whenever you see inflation, whenever you see this kind of bubble, what Fed does, they increase the interest rate. So the borrowing cost goes higher, and then economy slow down a little bit. One of the side effects of raising the interest rate is short term, the country may get into something called a recession, and also the price of everything goes higher. Like you see that the price of products, everything goes high. But we have 2 more things going on in this year. You heard the news about Russia and Ukraine. Because of that, the price of the oil pretty much jumped. And number 2, China still have a zero COVID policy, zero toleration in COVID policy. So a lot of areas in China are still in the lockdown. So that's why it's extremely important to understand that because of that, we're having a supply chain issue. Market, there are 2 rule of thumb. One, people are saying it, that if you take a look in 1970, 1982, I don't know if you remember Carter, Jimmy Carter came in as the president. I came to US in 2000, but my father used to tell me that in 1980s, the mortgage rate was 18% during Carter time. So market is scared if that happens, it will give into the long-term recession. But if you take a look at another chart I'm showing on the screen, this is in 1946. After World War II, Truman, the president, came in. At that time, a lot of soldiers came back to US, and there was a huge demand for supply, like steels and everything, because they want to build the houses and stuff. So there was a pent-up demand, and supply demand was constrained. So the reality of today's market is similar to 1946. Short term, because of the supply demand issue, the market will be very volatile. Inflation short term will be very high. But we believe that the Fed should be able to orchestrate this whole recession very smoothly. Because if you see, the economy is very strong. If you go to Disney World in Florida, you will see it's all packed. I tried to fly to Alabama to see my in-laws. The flights are fully booked. And for people who are unemployed, for every unemployment person, there are 2 jobs available. So we believe that it is true that short-term market is volatile, but long-term market will be fine. But as long as you have 2 to 3 years time horizon, I believe the market should be fine.
Thank you, Syed. Before we go to our audience asking questions, I want to ask you to touch one more thing, and then we will go for the questions. What are the planning and investment strategies in this market? What you suggest?
Yeah, I think one of the things to do in this market, rather than just being panic and sell everything, one option could be think about something called Roth Conversion. A lot of physicians, like who are self-employed, who has their own practice, or who actually work for the hospital, they all contribute into the 401k or IRA account. These are pre-tax money. But one thing, Dr. Ahmed, we have to understand that that when you retire after the age of 60, you have to pay taxes regardless at that time, right? So this is a good time to do something called a Roth conversion. Roth conversion means the pre-tax money, you can convert it right now into a Roth IRA. How does it work? So in this market, your portfolio, even if you are a genius, would be down 15, 20%, like everyone else, right? If you do a Roth conversion, what happens, the amount of money you're converting is less because the market is down. You pay less taxes right now. Let me give you an idea. Let's say you have $1 million in the market. I'm just showing you a chart. You do a Roth conversion right now in 1 million. And assuming you're a 30% tax bracket, we're talking about a tax due of $300,000. This 1 million, let's say, grows 9% per year. In 10 years, the value becomes 2.3 million. Yes, it is true that you have to pay the $300,000 taxes right now. The net result after 10 years, the value becomes 2 million. Versus if you don't do anything right now, this whole pre-tax, you leave it, there's no taxes due. But in 10 years, the value becomes the same, 2.3 million, but you have to pay taxes in the whole amount, in 2.3 million. So the amount becomes $700,000. So if you subtract the taxes, the net amount is 1.6. So the difference is almost $400,000 right now if you do the Roth conversion in 10 years. So again, if you have a lot of money in pre-tax in the 401k, since the market is down, the bottom line is it's a good time to convert the money, something called a Roth IRA right now, if you have the funds available. Second thing is I would recommend is something called a tax loss harvesting. What tax loss harvesting means, let's say you have a stock which are down, it's a good time to actually sell it, book a loss, and buy something similar. I'm giving an example. Let's say you have a company called Apple. What you could do, you can sell Apple and buy a company similar, let's say Amazon. So in this way, you can carry forward the loss, and every year the IRS allow you to claim $3,000 from your personal tax loss from the stock market. But if you have a real estate gain, you can claim it from the loss as well, and the loss you can carry forward as well if more than $3,000. So again, it's a good time to do something called tax loss harvesting. It's a gift time to gift money to your children if you want to the depreciated stock. Let's say Apple is down right now. IRS allow you to gift to your children $15,000 every year without filing any gift tax. So $30,000 husband, wife can gift it to the children if they want to. So if you gifted the depreciated stock right now, stock goes estate tax free. Again, it's a good time to do it. Retirees, for physicians who are close to retirement, they were looking for CDs. It's a good time to buy CD because the bank CD rate is almost around 2.5% 5-year CD. And the CD beauty is that is FDIC insured and principal is also guaranteed up to $250,000. And lastly, Dr. Ahmed, it's a good buying opportunity in this bear market because if you want to contribute into the 401k, whatever you will contribute until December, pre-fund it together and contribute now. If you want to open a 529 account for your children, whatever you do the rest of the year, do it now in one lump sum. Because, for example, the 529, the money you put in, the money grows tax-free, withdraw is also tax-free as long as you use it for education purpose. So again, these are some of the strategies. I know that it's a webinar session and I'm going very quickly, but it will be recorded. The audience can take a look and speak to their CPA and financial advisor that in this market, does it make sense or not?
Thank you. I'm going to ask the audience to type in your questions. This would be a good time if you want to ask anything about your tax strategy or your financial planning or investment. So I got a questions from Dr. Hassan Jaman. He's from Florida also. So he's asking, should I pour a little bit more money now? And if I want to do it, what should I buy? Do you have any suggestion? And also, like, he's asking, like, can I sell and buy the same stock? So I believe this answer, I know that, you cannot do this same stock, sell and buy and carry over the loss. So yeah, you go ahead, Syed, about his first question. Should I pour a little bit more money now?
Yeah, it is a loaded question. I mean, depending on the question that when are you thinking about retirement and can you hold on to it for 3 to 5 years? As I mentioned, the short-term market will be volatile. So if you are very close to retirement, like retiring, the next day or very short term, like less than 6 months, and you have a liquidity need, it's not a good time to invest because market will be volatile. But as long as you have a long-term time horizon, since the market is down, it's a good time. Definitely, it's a good buying opportunity. Number one. Number two, the question Dr. Zaman asked that what if I sell something? Can I just buy same stock back? You can after 30 days. So let's say you book a loss into Apple. I'm giving again as an example in Apple. You're at a loss, you sell it. As long as you wait for 30 days and after you buy it back the same stock, you can claim the loss, no problem. But if you buy it back the next day, you cannot claim it. It's called a washout lose.
We have one more question, and I want to add something to that question as well. Dr. Ajad Kobir, he's from Mississippi. So he's asking, what do you think about real estate investment now, given stock is not doing well?
Yeah, real estate, especially commercial real estate. So what happened, Dr. Ahmed, that Fed, if you see the 30 years mortgage rate, just last year was about 3. Right now it's more than 6. But people are still pouring in money because they have cash, right? At one point, the party will be over, like the way the stock market, suddenly the market went down. I have concern people will not be able to afford if the mortgage interest is this high. And just in case, if Fed cannot tame the inflation, the mortgage rate may jump up to 8%, right? So, and then Dr. Ahmed, a lot of people, not everyone go for 30 years fixed. In New York, like I did bought my apartment, I am actually something called 7 years ARM. That means for 7 years, it will be fixed. After that, it will fluctuate. So a lot of people's ARM or interests are going to expire this year, next year, who haven't refinanced it. So we believe that it's not a good time to buy real estate. We should wait, let the inflation stabilize. Let's see where the mortgage rate is in a couple of years. And the number two, the construction cost is very high, especially the commercial real estate. If you want to buy a strip mall, my client recently bought a strip mall in Texas last year. The same strip mall, we did a math, the construction cost is 40% high. So how are you going to rent it? That's the question. You have to increase your rent to collect this cap. So we believe that we should wait. The real estate market will be very volatile if the mortgage rate goes higher.
So Syed, this is my question, just from collecting from the information that you mentioned. You said from stock loss, that can you offset this with your real estate profit?
Yeah, so stock market, if you have a loss and if you have a real estate gain, let's say you sold a property, it's a similar way, same to same. So if you have a gain, let's say you sold a property, you have a gain, you have a stock market loss, you can offset it. But not rental income though. I'm talking about gain or loss portion. You can do that. So yes, it's fine.
All right, thank you. So moving to the next topic or next question. You also spoke about gifting to the children. What kind of trust is the best way to accomplish it?
Yeah, so one question, for a state tax point of view, so a lot of parents that we would like to give money to our children. So the best way is to give it to an irrevocable trust. Don't give under their own name because Dr. Ahmed, in US and up to an extent in our country as well, the divorce rate is going higher, right? The divorce rate is US and more than 50%. In our country is going higher. So imagine this way, you gift it to your children and they get into a marriage and get into a lawsuit or divorce, the money becomes half. So the best way to give money is to an irrevocable trust because the funds on an irrevocable trust for estate planning purpose cannot be touched in an event of a lawsuit or divorce. So that's why we are suggesting that sit down with the estate planning attorney, get the basic estate planning done, like get the basic will done, get the basic health proxies done, get the basic trust done. And within that, when you sit down with your attorney, they will advise you that irrevocable trust is one of the best way to give money to the children.
Thank you. I can add to that, when I did trust, my attorney suggested me to do the irrevocable trust. So moving forward, what are the mistakes to avoid in this market, especially who are close to retirement?
Yeah, so the three major mistakes, Dr. Ahmed, we see it in this market, people at least close to retirement, okay? Number one, using margin. Margin is like using a loan against your stock portfolio. Recently I was talking to a client who was a gastroenterologist. We took a look at the portfolio. Client is $1 million in the market, but 300,000 is in margin. Margin is like a loan. So the problem with the margin is that you lose double the money, because this is a loan amount we're talking about, and margin has an interest between 4 to 6%. So never use margin. It's called a kiss of death. Don't borrow money to invest into the stock market. Number one mistake. Number two, not properly diversified. So Dr. Ahmed, this is not a time to just buy and hold stock. All right. And I want to tell you why. I don't know if you recall in 2000 what happened. The dot-com bubble burst, like all the tech company went under. Everyone knows about it. Then 2001 and 2002, when I graduated in US, September 11 happened. So it took about 3 years in a row for the market to be down. At that time, Dr. Ahmed, a lot of tech company completely finished. Not everything went back up when the market recovered. So that's why it's important to readjust the allocation. So a lot of time we saw last year, people put everything into cryptocurrency. It's quite common, or they bought companies that went up a lot because of a pandemic. So make sure that you properly have all the exposure to the right stock. Like, for example, you should buy blue chip company like Home Depot, I'm giving an example, Procter & Gamble, or big blue chip name that can weather the storm well. Because when the market recovers, it's not for sure those sectors will go high. So make sure you're properly diversified, number two. And number three, the biggest mistake we see is market timing. Like, remember, I spoke about the story that my client asked me to sell everything. It's very common to see it that people actually buy everything, sell everything in this market. So market timing is not an answer, because if you took a look at the statistic, Dr. Ahmed, since 2001 till last year, the S&P, the market, is the annual return is about 7% per year. Okay. Now, if you miss the best 20 trading days in the market, just in case, let's say you are not investing into the market, you were busy with your life, your return instead of 7.5% becomes 0.1% only. Just in case, if you miss the 40 base trading days, let's say you are not investing into the market, your return becomes negative 3.4%. So the question becomes, how do you know that this is the bottom and this is the top? No one knows it. I don't even know it. So the best thing would be stay invested, but actively rebalance the portfolio. Market goes down, become aggressive. Market goes up, you want to be conservative, that's absolutely fine. So the third biggest mistake we see people make is trying to time the market. A better approach is the dollar cost average when the market goes down. So these are the three major mistakes we see investors make all the time.
Thank you. We have a questions from one of the audience, Dr. Adiba Giti. She's our scientific social secretary of the organization. She asked about, what about investing in government bond? Do you have any, government issued bonds?
Yeah, that actually lead to our second topic, sectors to focus on. Actually, it's great conversation. It's a very smart conversation. Like she mentioned, if you see first point in my slide, you should invest into Treasury iShares. Looks great what she asked about, because what happened, the Treasury bonds, Dr. Ahmed, the yield right now is as high as 9%, and Treasuries are very safe. So because of inflation, it is very high. The only problem with the Treasury iShare, the limit is only $10,000 per person. So if you, your wife, 3 kids, so the maximum you can put in is $50,000. All right. So yes, there's a lot of accounts you have to open. You can buy directly from the Treasury bond, or you can buy it from some institutions. But yes, the yield looks very attractive.
Next question is what sectors you suggest to avoid in this market?
Yeah, so before I get into the sectors to avoid, let me just finish what sectors to buy a little bit more. So Treasury iShare, like one of the physicians mentioned, is a great. Also try to take a look at the financial sector, like Bank of America, Chase. I'm giving an example. Those sectors tend to do very well when the interest rate goes higher. Consumer staples tend to do very well when it goes higher. For example, Procter & Gamble, Coca-Cola, these has the option to actually pass costs to the audience. So try to look into those sectors. Commodities like gold, silver, copper, they tend to do very well when inflation happens. And lastly, utility sector. Like I'm in New York. Last week, the temperature was 95 degrees, as bad as Florida. I had to turn my AC on. So whatever happened, I will always turn my AC on. So utility like Con Edison, those sectors tend to do very well. They pay a decent amount of dividends as well. So again, take a look at the sectors in terms of inflation. Now the sectors to avoid, like the question you asked, long-term bonds. Treasuries are okay, but if you're talking about long-term, let's say 30 years bond, 25 years bonds, bonds means you actually buy a company's bonds that give you, they promise you to pay a certain amount of interest every year. But if it's a long-term, what happened, the borrowing costs, the new bonds will be issued. So try to avoid long-term bonds. Pro leverage product means a lot of people buy, ETFs that goes double or triple the market. Try to avoid those kind of investment products. Like someone, I believe, asked from Michigan about real estate, commercial real estate. The construction ground up cost will be higher. So try to avoid commercial real estate, wait for the inflation to settle. And then garbage assets. What I mean by that, a lot of small cap companies, people are still buying it. Not necessarily, they may not come back. Stick with big blue chip company, avoid companies that just went up because of pandemic. So these are the sectors to avoid in this market.
We have a supplemental question from Dr. Adiva Geeti. Should Treasury I-bond for kids be in irrevocable trust?
Yeah, so amount, Dr. Ahmed, as I'm saying, the $10,000 only, the max you can put in. The irrevocable trust, costs some money, to do it, the cost versus the benefit. So our experience, like a trust costs about $3,000 to set this up at least. So if you're putting $10,000 and spending $3,000 to set up irrevocable, is it worth it? I'm not sure. If you already have a irrevocable trust, way back setup and gifting other assets already, you have your net worth. We would like to see for an irrevocable trust, the net worth is substantial. So if you already have it, then yes, it's fine. But don't just gift it through an irrevocable trust for only $10,000. The cost versus benefit, we have to take a look.
Thank you. And I want to ask the audience, if you like to ask Syed, any questions, please, put it in the chat box. Then I'm going to go into our last topic. In general, do you recommend physicians who are retail investors should buy individual stocks or index funds?
Yeah, so most of the time, Dr. Ahmed, that I see that physicians or individuals buy stocks, retail investors, because their friends are buying it, next door neighbors are buying it. We see in chat, people buy it, or they call each other, hey, I'm buying this, just buy it, get excited to buy it. If you ask Warren Buffett, one of the best investors, he's going to say, before you buy a stock, write down in a piece of paper why you're buying it. You do the analysis. If you cannot do it, don't do it. So our suggestions to retail investors to stick with index funds like SPY, like QQQ, like NASDAQ. So because in the long run, the index funds costs are very low. They tend to no one tend to outperform the market. And all you have to do, buy and hold. So if you're retail investors, our suggestion to stick with index funds. Let me just give you an idea that a few weeks ago, there's a company called Netflix. I'm sure you heard about it. It went down 50%. All the profit this stock had for the last few years went away. Is it going to go back up? Maybe, maybe not. We don't know it. But index funds is just a market, though. Market in the long run always goes higher. So it tends to be a little bit safer. So we recommend for retail investors not using financial advisors, stick with the index funds.
Thank you, Syed. I'm going to ask one last time our audience, do you have any questions? We are again sorry for the technical glitch at the beginning. We tried to solve it as quickly as we could, but even after that, it took 20 to 25 minutes. So we apologize for the delay. And he's giving his information on the screen, like, Syed is the partner of Wall Street Alliance, and his phone number, email address, all are on the screen. And one question came, Syed, like, people want to know how they can meet you in person during the convention. Are you going to give us any dedicated time?
Yeah, I will be, hopefully, Dr. Ahmed, you mentioned will be in the gala, making a small talk. And also we are having a get together, hopefully on Saturday afternoon. It's a lunch event. We're going to again send an invitation to you, and you can feel free to pass on to the audience who wants to attend. It's a RSVP option. So yes, we'll be seeing you, because I'm in Manhattan and I'm glad you're here. We'll be here for luncheon and also gala event as well.
Thank you, Syed, again, for giving us the time. And thank you, my audience, especially the fathers who sacrifice their important day, and, spend with us precious time. If anybody have any other questions, please feel free to write it down. Otherwise, we will be concluding our webinar. Thank you, Syed, for joining with us.
Thank you,
Look
Dr.
forward
Ahmed,
to work with you, and the organization will start a bonding with you, and for years to come, would like to see you partnering with us, and and we'll be inviting you for our next meeting and conventions.
Thank you very much.
And we are proud to have you there.
Thank you, Dr. Ahmed, for that kind introduction and for everything, and thank you again for inviting me to your webinar.
Thank you all. So that will conclude our session for today.
Thank you.